All right, so I purchased 9 buildings in the last year and a half, and only one of them was financed by a traditional bank. The other 8 buildings, I used one of the best strategies in commercial real estate, hands down. This strategy is the absolute secret sauce, and if you can master it, the sky is the limit with your portfolio and your cash flow. All right, so in this video, I'm going to be talking about seller financing. I'm going to discuss the difference between traditional financing and seller financing, and then I'm going to give you 3 different ways that you can use seller financing in your deals. If you're new here, my name is Graham Story. I'm a commercial real estate investor, podcast host, and broker. I make videos helping people get into commercial real estate and or transition from residential into commercial real estate. So if you're new, please subscribe and check out other videos on the channel. If you're interested in learning more about seller financing and this video maybe went a little bit over your head or was a little confusing, check out the link in the description. I created a free guide breaking down these 3 strategies, plus one of my favorite strategies that I didn't talk about that if you can understand and learn how to do, it's absolutely insane. So let's get into it. Traditional financing versus seller financing. So with traditional financing, you're going to be going to a national bank or a local bank. Think of like Bank of America, Chase Bank, First Citizens, those types of banks. When you go to them to get a loan, they're going to check a bunch of things, but they're going to check your credit, they're going to check your liquidity and how much cash you have in hand, and then they're also going to ask you about your track record and if you've done any commercial real estate deals this far. One of the main things they're going to look at is the debt coverage ratio. This is one of the most important metrics in commercial real estate or real estate in general. It's basically telling you how much debt you have on the property versus your rental income. So here's an example. If you have a $1,000 a month mortgage payment and your rent is $1,500 a month, then your debt coverage ratio is 1.5. Right now, banks typically want to see a 1.2 or 1.25 debt coverage ratio, which would be a $1,200 rent or a $1,250 rent versus a $1,000 mortgage. But with a traditional bank, they're going to look at the property's debt coverage ratio, and they're also going to look at your income, and they call that a global debt coverage ratio, which takes into account how much debt can the property cover and how much can you cover based on your income, whether it's from a W-2 or maybe you're an independent contractor, maybe you're an entrepreneur, and they're going to look at your tax return, they're going to see how much income you have coming in every month, they're going to take the property's income as well versus all your other debts, and then they're going to say, okay, this person can either afford this deal or they can't. So there's lots of different structures in lending, but the primary way I see it is typically you're going to bring 20 to 30% down on the deal. It's going to be amortized over 20 or 25 years, and then you're going to have a balloon payment of 3 years, 5 years, or 7 years. So amortization is the payment schedule your loan is on, but typically in commercial, the payment schedule is longer than the actual loan term. The loan term is what we call the balloon. So your balloon payment is how much principal you owe after your loan term. Whether it's 3 years, 5 years, or 7 years, you're going to have to pay that off. Now, typically people don't actually just go pay this off. They either refinance and extend their loan term or they sell the property. As of right now, interest rates are about 6.5% to 7%, depending on your location, the deal size, and the product type. Now let's talk about seller financing. Seller financing is way more relaxed, which is one of the reasons why I love it so much. So with seller financing, the seller is typically not going to ask you for your credit. They're not going to ask how much cash you have on hand, and they might not even ask you about your deal track record. Although it's good to talk about that if you do have a track record because it builds trust and will help convince them to actually finance you the building. So typically the seller is comfortable financing because they know where their security lies. They have a first position note on the property, meaning this person's probably had the property for 10, 20, 30 years. They've had it for a very long time. They know how to operate the property, and they have a first position note, which means that if you stop paying, then they would get the property back, which means they'd get to keep your down payment, they'd get to keep all the payments you've made and all the improvements you made to the property. So they're not that worried because if you default, it's almost better for them because they get the property back and everything you've done to it. Another big reason why sellers like seller financing is because it helps mitigate their tax burden. So if they've had the property for a very long time, let's say they bought it for $100,000 in 1985, and now they're going to sell it and they're going to sell it for $1 million. Well, that's a $900,000 gain. That is a lot of money. And if they sell that, the government is going to want their share. And the seller will be taxed on a lump sum of $900,000 in one single year, which can be upwards of 20%, which you can look into the long-term capital gains tax rates, but a lot of times it's 20% or more. Now, if they finance it to you, they're typically only going to be taxed on whatever they make that year. And in a commercial real estate scenario, that's going to be the down payment plus all the payments you make them. So if you buy $1 million property, let's say you put 20% down. Okay, well, they're going to get taxed on the $200,000 down payment plus all the mortgage payments you make on that $800,000 note. That's far less money than $900,000. It's going to lower how much taxes they have to pay, and it's going to prolong them actually paying the taxes over however long you negotiate the seller financing deal for. Now, I'm not a CPA, so make sure you double check and triple check with them before you do anything like this or explain it to a seller because I don't want to tell you wrong. I'm just telling you all this stuff based on my experience. So as far as structuring these deals go, there's really no set structure. Everything's flexible, everything's negotiable. That's one of the reasons why I love it. You can craft seller financing to make your deal work. Now, obviously, you shouldn't craft it just to buy a bad deal. You should always look at the fundamentals, but you can use it as a really, really good tool to make the deal even better. And it's a win-win. So I'll give you the structure that we've used for 8 of our buildings. We like to offer 10% down, 5.5% interest, a 25-year AM with a 5-year balloon. This gives us the ability to get in the deal light with just 10%. It gives the seller a good amount of cash flow because they're financing 90% of the deal, and it's giving us 5 years to stabilize the property and do whatever we need to do to make sure that in 5 years we can refinance and or sell. Because the seller's financing 90% of the deal, that means their payment is going to be higher and they're going to get a good amount of cash flow. They might get as much cash flow if their rents are low as they were receiving before, but they're not dealing with any of the headaches, the maintenance, the taxes, the insurance, none of that. They're just getting a mailbox check from you. Some sellers absolutely love this. We actually had a guy call us after closing our first deal. We'd been paying for about a year on seller financing, and he said, hey, I got another building. I want to sell it to you on the exact same terms. I'm telling you, if you can master this strategy, the sky is the limit. So now I'm going to give you 3 different ways that you can use seller financing. So option number 1, it's just a straight seller financing deal. Just like the example I gave you, maybe you give them 10, 20% down. You're going to finance the debt over 20 or 25 years at a 5-year balloon, or maybe 3-year balloon, or maybe a 7-year balloon. The seller's going to be in first position, and this is just the simplest, cleanest cut way to do a seller financing deal, and you should absolutely try it. Option number 2 is what we call a seller second. Now, I've not pulled this one off yet. We've tried a couple times. It's a little trickier, but people do it. Just because I haven't done it doesn't mean that other people haven't done it. So in this scenario, you're getting the seller to finance 20 or 30% of the deal, and you're going to probably use this as the down payment. But they're going to be in second position, meaning the bank that you're going to bring in for the other bit is going to be in first position. And what that means is if you stop paying as the borrower, then the bank has the first position or the first right to come after the money. They're going to take the property, they're going to sell it, and they're going to get paid off. The seller, who's in second position, might not have enough money left over after the bank gets paid to get his money back. Therefore, it's a much riskier position. So they're going to finance 20 or 30% of the deal, and then you're going to get a traditional bank to finance the other 70 to 80% of the deal, which is the other caveat. You have to find a bank who's willing to do first position with a second seller financing note behind it. There are banks out there, we know several of them who will actually do this, but not every single bank will do this. And if the bank is willing to do it, typically they want a little bit of skin in the game, so they're going to ask you to put down 5 or 10%. But still, putting down 5 or 10% is way better than putting down 20 or 30%. Then there's option number 3, which is seller financing plus hard money. This is a strategy I covered in my BRRRR video, which I'll link right here, and we have actually used this one. So in this scenario, you're going to get hard money for the down payment of 20 or 30%. And that hard money is going to be in second position, meaning they're going to be after the seller. The other 70 to 80% of the deal is going to come from seller financing, and the seller is going to be in first position. So you have to be able to do 2 things. Find a seller who's willing to have a second position note as the down payment, and then also a hard money lender or a private money lender who will lend you the down payment in second position. They're out there and they will do it, but typically you're going to have to pay anywhere from 12 to 15% on that money to get the deal done. Now, there's a major caveat with the last 2 options that I gave you, the seller second and the seller financing plus the hard money. You have to make sure that you get a very good deal. You cannot do this on an average deal because you're basically leveraging 100%, which is very risky. So I'm not advising everybody go out there and do this. I'm just saying if you find a very, very good deal like we have, then you can use these tools, buy the deal, stabilize it, and then refinance or sell or do whatever you need to do. So that's just 3 ways you can use seller financing. There's literally hundreds of ways you can use seller financing, and it's one of the best strategies out there. So hopefully this was helpful. You learned a lot, and you can take this and go out there and do more deals. Be sure to like, comment any questions, and subscribe for the next one. Thank you so much for watching.